Well, hello, everyone, and welcome to the Greater Central Florida Multifamily Investors Group meeting, where we focus on investing where it makes sense. I'm your host, Ismael Reyes. This meetup is for anyone who wants to grow their wealth through multifamily real estate investing. Whether you are a beginner or an experienced investor, you will learn valuable information that you can use to start or grow your real estate empire. Maybe empire is too big, but your real estate wealth. On to today's topic. As many of you know, the multifamily real estate market has been on a tear in recent years. Prices have skyrocketed and rents have followed suit. But there has also been some challenges many investors and operators are facing in the current market. Rising interest rates, inflation, supply chain disruptions, labor shortages, skyrocketing insurance rates, especially here in Florida, and to top it off, a potential recession may be looming. There's a lot going on. Yet, despite these challenges, the multifamily real estate market is still expected to grow in the near future due to rising rents, single-family home unaffordability, demographic trends, job growth, and my personal favorite, housing is a need, not a want. So regardless of where kind of are in the cycle, we still need to be in a place that we can feel safe and away from inclement weather. So which and where is it? Let's dig in. Today, we're fortunate to have Carl Whitaker, Senior Director of Research and Analysis at RealPage, with us to discuss the current state of the multifamily real estate market. For those of you who don't know, RealPage is a leading global provider of software and data analytics to the real estate industry. They have some very, very good data that Carl is going to share with us today. I love it. But before I turn it over to Carl, I'd like to announce a speaking engagement I have coming up in Orlando that some of you might want to attend. All right. I think you guys are seeing the Old Town REI Summit. So the Old Town Real Estate Summit, this is an inaugural event for them. It'll be on September 23rd. And we're expecting a room full of real estate investors, entrepreneurs, and like-minded individuals that want to learn and grow. I'll be providing an introduction to real estate syndications. There are other folks that are talking about other topics because it's not focused on multifamily. But I think the biggest thing that anytime you get a group of folks, real estate investors, the networking is the key, is the critical aspect. Hopefully you get a chance to attend that. And the QR code there to the right of my ugly mug will give you a 25% discount on what's already a reasonable price. Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. And so without further ado, I want to formally introduce Carl Whitaker to the show, our distinguished speaker. Carl Whitaker is a Senior Director of Research and Analysis for RealPage, Inc., where he blends his passions for geography, economics, and teaching to foster a practical applied understanding of apartment trends and forecast expectations. Prior to joining RealPage, Carl worked as a consultant with Catalyst Commercial, and an economic consulting firm based in Dallas. Carl received his bachelor's degree in secondary education and a master's degree in applied geography from the University of North Texas. Carl, the floor is yours.
Wonderful. Thank you for the kind introduction there, Ray, and good to see you again. I know this is the second or third time that we've had the pleasure of chatting. And to those of y'all joining on today's discussion, thank you for taking some time out of what I'm sure is a busy schedule. What I've got planned here for the next few minutes is I was going to touch on some broad national themes, just what we're seeing in the data from the apartment market landscape. As we heard earlier, the idea behind the webcast here, or the webinar, is to cover the good, the bad, and the ugly happening in the industry right now. So I'm just going to color in some of those very high-level national themes. Certainly want to encourage questions. Please send those along. I'll try to do my best monitoring the chat there, but if any questions come up, feel free to come off mute and interrupt me. I don't want to sound like I'm stealing too much of the conversation here. So with that, any questions before we get started, or do we just want to dive right in? All right, well, we'll go ahead and get started here. So I think one of the things we've really been kicking off this quarter's lead story with, if you will, is that a lot of the data in the apartment landscape today comes down to, I think, whether you're an optimist or a pessimist, and you're going to hear me echo that a couple times. I tend to lean a little bit more on the optimism side of the equation for some of the reasons that I'll highlight throughout. But here's a good example of where the storyline can be both true of optimists and pessimists at the same time. So quick takeaway here, what we've done is stacked up about 20 years worth of net apartment absorption. In other words, taking the number of occupied units from one quarter to the next. And this is looking just at second quarter alone. And you can see that after this really bizarre freeze in household formation that we saw in 2022, for reasons that I'll talk about here in a little bit, but after that really bizarre freeze, this same time last year, we saw that second quarter 2023 absorbed about 84,000 units. So to me, it kind of seems like, if you're a football fan, I almost see that 2023 number as just getting a first down after you had a really rough set of drives the year prior. Now the pessimist looks at this and says, well, second quarter 2023, yeah, maybe that's okay, but we still lagged the 20-year average for absorption. Again, I tend to lean a little bit more optimistic in this, where I think that we're just encouraging to see the ball moving in the right direction, for lack of a better term. And again, you'll hear some of the reasons why I think that is here in a second. And this is another way to characterize that. So just covering again, this is looking at second quarters over the past 20 or so years. This is looking just at a quarterly snapshot over the past 3 years. And what you'll notice is that after this really incredible run up in apartment absorption in 2020 and through the first part of 2022, at least, we saw that demand was pulled forward. We saw a big shuffling of population around the country. We saw that wage growth was soaring. We saw that job growth had quickly recovered in 2021. And really what happened is I think you saw a lot of demand got pulled forward as a result of the pandemic. And because of that pulling forward of demand, at some point we were going to start to see the rebalancing. In other words, this wasn't an infinite trend. I think that the fact that you saw 2021 in particular, the fact that you saw essentially 2.5 years worth of demand squeezed into one meant that at some point you were going to see the inverse of that. 2022 in some ways was the inverse of that. Now, again, the pessimist looks at this and says, yeah, weakest demand since 2009. Anytime you're comparing a real estate trend to 2009, you're already kind of up on the ropes there. But again, I don't tend to see this as quite as pessimistic as what the numbers may say, simply because of that pulling forward effect. On top of that, that was a pretty brief period in time. You have seen that the rebound, while not spectacular, you can see that the rebound has started to materialize. And then the last thing I'll point out here, and just to tease a slide that I'll share here in a second, I think the biggest thing that caused 2022 household formation to freeze was simply that consumer confidence eroded so quickly. So keep that little nugget of information in your mind as we go over to the next few slides here. Now, with absorption trailing typical norms, that stands to reason that you're seeing that rent growth is also trailing typical norms. What we've done here is just taken the percent change in national rents from January through July over the past, call it 13 years at this point. And what you'll notice, really a few things on this slide that I think are worth calling out. One is that both 2021 and 2022 were record years in terms of year-to-date rent growth. Similar to what I said earlier, at some point that was going to start to normalize, and I think we're starting to see how that normalization is playing out in the 2023 numbers. Now, again, I don't want to sound like a broken record here, but the optimist looks at this and says, hey, we've had positive monthly growth in each month of 2023. That's pretty incredible considering we're on the cusp of delivering more apartment units than we have at any other time in the past 40 to 50 years. So the fact that you're getting positive rent growth at a 40 to 50 year supply peak tells me that demand and absorption are pretty good with that supply backdrop in mind. Now, the other thing that I would mention here too, and this is just, I say this somewhat in jest, but somewhat seriously, you look at 2010 through 2019, that's going to be each of those individual gray lines. 2010's average is just cutting through the middle of that, of course. And it's fascinating that in the 2010s, a lot of my job was like being the weatherman in San Diego. It was pretty easy in some ways. You kind of saw how the industry was performing. Since then, however, you see that the past 4 years have been anything but normal. And the reason I mention that is that I think it's important to, as you get into 2024 and 2025 in particular, I think it's important to use the 2010s as a better baseline than it is 2020, 2021, or 2022, because the pandemic disrupted so much of the economy, so much of the market trends, and so much of the housing market at large. So all said here thus far. Any questions, comments, or do we just want to keep on rolling through and see how the conversation unfolds?
Good info, but yeah, I think we're just getting started here.
Okay. All right. So this is another thing that makes me think that the market is probably in better shape than maybe what some of the rent growth numbers suggest. You look at something that we consider a leading indicator of demand. The traditional metrics, wage growth, job growth, those are useful, but this is a really fantastic metric that comes from RealPage's systems that shows leads created, guest cards created. In other words, how much new lease traffic is coming in the front door. And in theory, new lease traffic coming in the front door is a future indicator of how many signed leases you're going to have, how much demand is going to be entering a market or a specific property in some cases. And what you'll notice is that 2023 second quarter followed pretty normal seasonal patterns. And on top of that, 2023 is basically at what you would expect for the long-term average. And this is a 10-year average here. 2023 is basically right on par with that. Now, again, the pessimist says, well, leads are below where they were in 2021 and at least the very, very, very first part of 2022. I tend to be more optimistic here once more because I don't think 2021 and early 2022 are quote unquote fair benchmarks, knowing what we now know about what happened post-pandemic in the housing market. I think that 2010s to decade, call it 2010 to 2019, I think that's a much fairer benchmark. But the takeaway here is once more that you do have leads out in the market that tells you that people are shopping apartments. What this doesn't necessarily highlight is that one lead could be shopping multiple apartments. And I think this is where the supply story comes into play. Back in 2021, early 2022, national occupancy was at 97 to 97.5% in most major metros. Because of that, when one lead came in the door, it was basically a lead that was backfilling a recent vacancy because there weren't many vacancies. Today, you have a little bit higher vacancy, basically a 20-year average for vacancy that I'll share in a second. But the fact is that you have one lead, they may be shopping 2 or 3 other assets. So I think operators are playing a little bit more conservative on the rent growth side in an effort to preserve occupancy. Some of that's operational strategy, there's different perspectives there, but that's what we see in the national numbers. And much like I said earlier, this is kind of a fun metric to look at, but this is looking at how consumer sentiment tends to predicate what happens with absorption. So look over a 10-year period, 15-year period, even over here on the left, and that consumer sentiment index, it's not necessarily the magnitude of the line that's important, it's the directionality of the line, and it's the changes in magnitude. And as you see, generally speaking, when consumer sentiment drops, it's not long after that apartment absorption does as well. Conversely, when sentiment improves, you start to see absorption do so as well. And if you think a little bit, if you dig a level deeper into what this trend is really signaling, when consumers feel better about their economic choices, they're more likely to go make big financial decisions. You know, if you're hearing tens of thousands of layoffs, you're not probably going to go out and buy a new vehicle. You're probably not going to go buy a new house, move into a new apartment. In fact, human psychology kind of comes down to the fact that you tend to wait out storms when they're happening. And we actually saw that where resident retention reached an all-time high. In other words, people weren't shopping apartments whenever consumer sentiment was starting to plummet really sharply the same time last year. In other words, they were just electing to renew rather than move. Now, the good news in this trend is see how this consumer sentiment here has sharply improved over the past couple months. And because of that, you're seeing that absorption is also starting to improve. That bears out on a quarterly basis as well. I think that the fact that consumer sentiment has improved at its fastest monthly pace or fastest year-over-year pace in something like 5+ years, to me signals that you're going to see some demand start trickling out into the market. We're probably not going to hit 2021 levels again anytime soon, if ever, but I do think that we could get back to a more quote unquote normal year using 2010 to 2019 as that baseline.
And Carl, does this take into account seasonal differences?
It does. Yeah, that's a good point. So this takes into account seasonal differences, and you can see it a little bit on the quarterly absorption, where second and third quarter, generally where you get the strongest absorption, first and fourth quarter, fewer people moving around. Now, the one thing, that's a good point, Ray, because one thing that's also been disrupted from the pandemic that I think is now starting to normalize is that leasing schedules and really just the market in general, the seasonality was disrupted because of the pandemic. People couldn't move at times of the year when they typically would. Maybe somebody was moving from a coastal city or a higher cost of living city into a more affordable city. I think you saw the echo of that over the past couple quarters. Now, my take on it is that you're starting to see more quote unquote normal trends starting to emerge. And then this is basically the same thing we just shared on that last slide. This is just kind of highlighting how much consumer sentiment has jumped. And I think I said 5 years. It's actually 10 years that you've seen this big of a jump in consumer sentiment. So again, the takeaway is that sentiment's improving. We think that that's something that signals that apartment demand is well on its way to also improving, or apartment absorption, I should say, is also improving. Now, when we look at one of the reasons why consumer sentiment is starting to fall, I think another thing that it doesn't necessarily come out in the headline numbers so much, but when you look at overall inflation being measured by CPI, or Consumer Price Index, you look at inflation overall, it's actually coming down really, really quickly. The one difference is that if you include rent in the CPI calculation, inflation isn't falling quite as quickly, but this is a methodology quirk that's in the BLS numbers. In other words, the rental rate that's measured in the inflation calculation is 12 months lagged. So if you remove that 12-month lag in the equation, we're seeing that, again, inflation is slowing. And I think the fact that inflation is slowing, people are starting to feel better about their economic prospects. The worst fears of a recession materializing in 2022, none of those things really came true. And in fact, we're seeing that some of this improvement in the economic situation, or the economic backdrop, at least relative to where it was last year, is signaling that we're probably on a path for stabilizing apartment demand. And then looking back at that discussion point earlier on occupancy, we have seen that occupancy's come down from its recent peaks. Some of this is a supply story. We're adding a lot more supply to the apartment inventory, something like 1 million units under construction nationally. And this is what supply does. When you add more supply to a market or to a neighborhood, it tends to pull down occupancy because you're just adding more units to the existing base. I don't actually see that as a quote unquote bad thing, though. In fact, I actually think it's good that we're adding more housing units to the national housing stock, because we are at a critical shortage of national housing. On top of that, 97.5% occupancy was never really sustainable. And because we're measuring on this particular metric, we're measuring physical occupancy, not economic occupancy. And what I mean by that is that late 2021, early 2022, this was still before some of the evictions were fully materializing. This is when a lot of the bad debt was still building up on rent rolls. Today, I think the economic occupancy, in other words, what percent of renters are paying their rent, and the physical occupancy, how many people are actually living in those units, I think those two numbers are closer together than at any point in the past 2 to 3 years. And that's why you've seen that the occupancy rate is now basically at a very, and again, the term comes up again, but again, a very quote unquote normal level relative to where you would expect it to be. And then one other thing I'd add too that I think signals that demand is improving, occupancy rates are starting to become a little bit more stable. When you look at the month over month change in occupancy, we really haven't seen occupancy fall all that much through the first half of 2023. In fact, when added all together, occupancy rates have really only moved a couple basis points from the start of the year. Compare that to where we were this time last year, when occupancy was falling, 50 to 100 basis points in a given month. Today, that pace of contraction is really not even happening. It's just kind of stabilizing. So I think you're seeing that altogether, occupancy is stabilizing. Now, granted, rent growth maybe isn't as strong as where it was the past few years either, but the fact that occupancy is stabilizing and holding stable, considering so much construction is happening, is a good sign for the market in a lot of these markets that may come up in the later discussion. And then real quick, one of the other things that I think is helping occupancy stay stable is that you have pretty high resident retention. In other words, residents aren't necessarily moving out upon the first lease expiration. RealPage data shows that on a trailing 12-month basis, about 54% of residents decided to renew their lease. And that's a number about where you would expect to see it if you drew a 10-year average. This is something that we think says, maybe you're not getting as many renewals as you were back in 2021, but keep in mind back in 2021 is also whenever the market was in that big shift. You were having a lot of other things informing that retention rate. Today, things look pretty normal, and I think this will be a better baseline going forward into 2023, second half of the year, certainly into 2024. One other thing that may be impacting the retention rate too, and this is something that I think operators are using not only to help rebalance seasonality, but I think also in an effort to stave off some concerns about supply pressure, residents are signing longer leases than ever before. And I think to borrow a phrase here, operators are essentially taking the leads number that I shared earlier and using the aphorism that a bird in the hand is worth two in the bush. And what I mean by that is that if you have a good qualified lead today and rent growth is happening and you're able to keep your occupancy stable, you're willing to take that and lock it in over a longer term lease than hoping that things improve in the second half of the year. And I think it's a smart strategy just to go ahead and lock in longer term leases today, because it's also the more beneficial scenario for the renter. You're essentially prolonging or prorating, I should say, the life of that lease in terms of its effective rents. In other words, it tends to be a better deal for the resident. The operator gets some benefit because they're also able to stave off things such as turnover cost. And I'll share something here in a little bit that shows how turnover cost is a really, really rapidly expanding expense category. So this is where the data starts to get a little bit more nuanced. And if I need to pause at any point here, feel free to send me a question. I'll try to keep an eye on the chat best I can. But one of the things that we looked at in the second quarter data, we took a quick snapshot of what percent of submarkets across the country are seeing year over year rent cuts. It came out to about 28% of the 1,000 or so submarkets that RealPage classifies are seeing cuts on a year over year basis. That number has grown as we look at the June and July figures, but there's more than meets the eye here. So really what I would say the takeaway here is that 28% of submarkets seeing rent cuts. Sure, that's larger than the past few years. It's smaller than 2020. But the important takeaway here is that if you take those submarkets that are seeing rent cuts, the average rent loss is about 2%. However, consider the other 70-75% of submarkets that aren't seeing rent cuts. And when those rent cuts aren't happening, the average growth is still about 4%. And this is this is a story that's pretty easy to dissect. You see that rent growth, generally speaking, is stronger in the areas that aren't delivering as much new supply. And what this percentage on the bottom here shows you as a percent of existing stock, how many units were delivered in these submarkets. In other words, for every 100 units delivered, for every 100 units that exist in these 689 submarkets over here, 1.7 or call it 2 units delivered. Now in this 285 total over here, about twice as many units delivered on a relative basis. And the percentage change might not seem like that much, but when you consider that there's 18 million apartment units that fall into this analysis across the country, a few percentage point shift is significant. You know, you're talking hundreds of thousands of units at that point. So again, the takeaway here is that rent growth is still happening. It maybe is a little bit more isolated in parts of markets than it was, say, 2, 3, 4 years ago. But the good news is that when rent growth is happening, it is still relatively strong by historic norms, or relatively normal by historic norms, I should say. And it's really a supply-driven story more so than it is a lack of demand story. And that's maybe the key takeaway on the rent growth side of things today. And then real quick, this is just a quick breakout by Class A, Class B, Class C, new leases, renewals. Quick takeaway on this is that even though Class A is getting a lot of new units delivered, you're still getting relatively strong trade out on those new leases. Renewals are still growing at 6%. So focusing on those trade out numbers is a good story right now. The year-over-year effective asking here, this is basically an advertised rent. This isn't necessarily what gets executed on rent rolls. So you're seeing a little bit of a gap in the advertised versus the executed today. But essentially, again, the takeaway is that rent growth is still happening across all product classes. It is slowing here in the July and August stats, but still positive in terms of that new lease and renewal trade out. And then this really goes back to that point I made earlier on how inflation comes into the equation on effective rent, or really I should say it the other way around, when effective rents, how it comes into the equation on inflation. And you can see how that 12-month lag effect comes in to the inflation equation. In other words, rent growth is slowing faster than what inflation is showing. But I do think that that is something that sparks positive consumer sentiment, and you could see consumer sentiment improve over the, I'm sorry, you could see apartment absorption improve as that consumer sentiment does so as well. And then one last thing on inflation there, I won't go over this in great depth, but I thought I'd share this as just an inflation metric worth including in the deck. So a couple more things here. We heard Ray talk a little bit earlier about insurance costs and how those have been a pesky category in terms of year-over-year increase. We actually see that it's the second largest expense growth on a per unit basis in the country. Insurance costs up about 20% year over year across the nation. Turnover costs are slightly larger in terms of their percentage increase. Now, of course, turnover costs are going to make up a much smaller piece of the pie than the insurance costs are, but turnover costs are increasing. And again, this goes back to that idea earlier that I think you're seeing longer term leases locked in an effort to help cut down on turnover costs. Meanwhile, you look at some of these other categories, marketing, payroll, utilities, taxes, et cetera. The pace of increase on those expenses is coming down in line with inflation. I think the biggest concern over the next couple quarters and next couple years even is just a question on what happens with insurance costs. And then here's a really quick summary on some regional themes that we think will play out over 2023 and 2024, what markets and what regions we think will lead in terms of rent growth, which parts of the country we think will be average, slightly worse than average, and laggards. Keep in mind, this is a regional overview. There will be market level differences, and this is where it gets a little bit tough when talking about market level forecasts. Is, you know, it's just we're presenting something national here, and real estate is ultimately local, if not even hyper local at a neighborhood level in the grand scheme of things. But this is generally where we see the headwinds and tailwinds, if you will, at a market level. Now, the question maybe on some of these markets is, well, why some leaders and why some laggards? Again, the biggest takeaway is it's where markets are getting the most construction. We think those markets will fall below the national average in terms of rent growth over the next few years. Now, the takeaway on this slide, though, as well, is that while that number of units delivering 2023, 2024, that is technically a 40-year peak in terms of new deliveries. It's important to remember that 700,000 units delivering in 1972 is way different than 700,000 units delivering in 2023. In 2023, you had something like 100% more working age adults in the country than you did 40 to 50 years ago, something like 153 million versus 78 million back when this analysis was done in the 70s. So really the takeaway here is once more that you're seeing that completions are big on a nominal level, but relatively speaking, that construction number isn't nearly as big back in than it was back in the 70s, whenever the market got a little bit too top heavy in terms of construction. The other takeaway on construction is that we're already starting to see that this number is coming down very sharply. This is looking at the number of units started by quarter. And we saw that in second quarter 2023, across the country, you actually had 50,000 fewer units started than one quarter prior, a 40% drop. Now, the question here is, well, why the drop? A lot of this is construction financing. Some of this is developer sentiment. But, if you were able to secure financing on a construction loan 2 years ago, you were able to get that property started. Today, it's a very different story in actually being able to secure that construction financing loan. And in some ways, you can think of this the way that home buyers are looking at mortgage rates. 2 years ago, mortgage rates were at 2.5%, maybe 3% was a viable mortgage rate. Today, those rates are at what, 6.5%, 7%, maybe off a little bit on that. But again, the takeaway here is that starts are falling. This signals to us that by 2025 and especially 2026, you're going to see fewer units actually delivering because that starts number is coming down. And then last two slides here, I won't go through this in great depth, but this is just kind of looking at some of those forecast headwinds and tailwinds we see in the market. The biggest headwind is pretty clear, what happens with construction. The other headwind that we don't necessarily see happening, but it's something to consider. Ray mentioned earlier that there is always that fear of a recession materializing. We tend to think that job growth will slow over the next few quarters, but we don't think that there will be a true quote unquote recession materializing. I think really you've already kind of seen the impact of a lowercase r recession impact sectors such as the tech sector, for example, where you saw a lot of the layoffs happening in those West Coast markets. Today, I don't think that that's materializing at a national level. Tailwinds, they're still out there. Inflation tapering off, that says a lot about consumer confidence over the long term. I think it also helps the NOI equation. If you see that operating incomes are growing, that's one thing. But if you also see that operating expenses are falling, then that's going to be something that translates more to that inflation number. In other words, inflation affects the operating side of things just as much as it does the income side of things. And we are starting to see that inflation is dropping. The other thing that I think is a potential tailwinds is that the lack of demand that didn't materialize in 2022, could some of that be pent up and release in 2024 in particular, as the economy is able to maintain relative stability, maintain relatively stable, maybe not fantastic job growth, but still seeing it, inflation's cooling. I think that you could see maybe a tiny trickle of pent up demand releasing, and that's going to be something that's clearly a plus for the apartment market. And with that, that's our basically our 30-minute national overview. Happy to talk markets, happy to talk some other trends if we would like, but hopefully that helps set the stage for the national discussion.
Thank you, Carl. I guess from my perspective, obviously being here in Orlando, I think it's important to note that Orlando did have a ton of absorption in this market that is still trying to play around with. So there were a lot of construction here in Orlando. So I think that's going to be obviously an impact here in the future with regards to multifamily and even real estate overall. Although, I mean, pricing and to the point that you made, it really hasn't gone down. I'm not talking just rents, but I'm also talking sales prices on houses. I mean, they're really, you keep hearing that there's going to have this huge fall off. We haven't seen that at all.
Yeah, it's an interesting point on absorption too. We do see that Orlando and really Central Florida still has some of the strongest absorption in the country, and some of that it almost sounds counterintuitive, but when you're measuring absorption, you can only absorb what is made available, and new supply is the quickest way to make things available. So we're seeing that absorption is still strong while this new supply is delivering. I think the concern would be that if supply was delivering and absorption wasn't happening, then you would see rents and occupancy fall more quickly. But to your point, we're not seeing that in some of these markets that still have strong absorption.
And we continue to see people come down here. I just saw a report a few days ago that essentially the numbers haven't changed as far as demographics, regional demographics. People keep coming down. I mean, until that trend, which those trends take a lot longer to change than your typical economic trends, and until that changes, right, it's always a positive. But there are these little dips that you got to deal with. I think the biggest thing here is really insurance. Maybe Central Florida, not as much as the coastal markets, but there is still an impact, significant impact. In fact, one of our properties in Tallahassee this last year had a 22% increase in insurance. And you're thinking, okay, Tallahassee, I guess it's sort of close to the coast, but not really. So
Right.
it had been a little bit tough on NOI to when you have to take that, and obviously that was even higher than we budgeted.
Right. My own house. When I purchased this house in 2014, I think. I think I paid $2,000 a month for home insurance. I pay $4,300 right now for my stupid house.
It is a nice house. I've seen pictures.
$4,300 right now.
Yeah,
and I got 5 cars, and I still got 2 kids in here, 5 cars, and one and a motorcycle.
Yeah, no, they I think it does have across the country. I think there has been an increase, but certainly here, everybody's holding their breath with any hurricanes and flooding and this sort of thing, and people keep leaving the market as far as insurance goes. Although I just saw that that essentially the state told the insurance company of last resort to go back and re-wicker some things because they felt it was still too high what they were offering. So we'll see what that looks like. I'm surprised, Carl, that you didn't think that labor was as much of an issue. I tell you, we have a hard time. We got some properties in Dallas. We've got some properties in Florida, and keeping quality people is difficult. And the prices to bring them on board is gotten pretty high, which is a good thing. But that you still have to, at some point, you got to factor that into the overall equation, and you got to try to raise prices to adjust. But problem is the price stickiness, which if you start getting these longer rents is even going to be even more difficult. But you're competing with short-term changes in these expense factors, and you've got a 12 to 15 month rent or lease that you have to deal with, and it does create that imbalance.
Right. Yeah. And we are seeing that. I think that slide showed that payroll is up about 10% year over year. And that's still much higher than it was at any point in the 2010s decade in the grand scheme of things. But as inflation's cooling, we're seeing that wage growth is also starting to basically match with that. There's a component of inflation that's inherently wage growth driven, and it kind of becomes a chicken and an egg scenario. But to your point, it is.
Yeah, and the other thing is, and maybe not on a national level yet, but we had a ton of people that left the job market that are never going to come back. So I think as far as pricing goes in jobs, you're starting to see all the baby boomers are basically, some of them retired early, the ones that were still had a couple of years, they're not coming back, and you still continually see more baby boomers leaving that market. And so you are going to have this competition for jobs as far as pricing goes for a while. So I don't see, maybe it's leveled off, but I still see a lot of competition for jobs. And really this younger generation is going to have a good time with some of the opportunities they have, because there's just not enough people working. And I think the construction field, for example, they have a huge deficit. They can't even find people to work. So that chart that you showed that had essentially a gap of new deliveries, I wonder, although it was just a quarter, but I wonder if any of that has to do with just scarcity of labor, especially skilled labor.
And I apologize there. I dropped for a second. We're getting some internet work done on our neighborhood here, which they're not working on it right now, but we've had some intermittent internet disruption. So I apologize. I may have missed that last comment there.
Yeah, no, I was commenting, Carl, on the labor scarcity that we have for basically higher skilled labor, right? I mean, it's gotten tougher, and I think that's gonna drive some of the future deliveries. Things are just gonna get slowed down. It's just gonna take longer to bring construction to bear not just because of the financing, although that's a big part of it, but also because it's hard to find people to do some of this work. Tried finding a plumber. It's a fight. Like you're like, are you kidding me? How much do you want, man? We got plumbing work. But are you seeing any of that as far as in any stats nationally that the scarcity factor?
Yeah, it's hard to say on the construction side. I do think that construction financing has been something that's been more of an explaining factor for why delays are happening. However, on the operations side for existing properties, we have been hearing that for a while now, that finding just enough skilled labor out there has been very challenging. And I'm going to get this exact stat wrong, so don't quote me on this, but I think I remember hearing 2 or 3 years ago that the average age of the master electrician in the country is something like 58, and there's just not enough young adults backfilling that pipeline essentially. And that's just one trade that obviously has huge implications for apartment properties. So like you said, when you start thinking about plumbers and drywall and masons, and there's a lot of that skilled labor out there that is just, candidly speaking, kind of tough to find. So I think that's something that is informing some of that challenge, as we mentioned earlier, particularly on the O part of the NOI equation.
Yeah, I don't see prices for housing going down anytime soon. Everything just keeps driving the price up. And it's good that, inflation is coming down some, and some of the supply issues are easing, but I still see labor playing a big role and just the ability to price things out. But that's good. Any other questions, guys? I know Carl, are you in Dallas now? Where are you at?
Yeah, I'm still in Dallas area. Moved about an hour and a half east to Dallas. So I'm out in the country, hence the internet hiccups there. But yeah, still Dallas area.
Hey, Ray, I'm noticing the same, on my end, more on the smaller scale. I have some projects going on the west coast of Florida, like Sarasota, just a little south. And, I've gotten tons of quotes over there, and, I'm most of my guys are on the East Coast, southeast coast of Florida. And it makes more sense to, have them go over and just knock out the jobs, because, it's the guys that I am finding over there are just, they're a lot more expensive, and the quality of work is just not there. You spoke about the average age of electrician. The guy that I've been really working with down here, he's 34, 35, and he gets after it, so he drove across the state of a couple of projects and knocked them out pretty quick, and I couldn't find anybody over on that coast, so it's been a challenge.
On the West Coast, did you say?
Yeah, on the West Coast. I mean, I find people, but it's just it's different. It's a different mindset, from the guys over, that work like the Miami, Fort Lauderdale, Broward. They get after it, and like you said, though, people are leaving too, with I think DeSantis passed that thing, and so yeah.
I wonder if the impact of the hurricane that came through is part of that, because I was trying to work with a contractor on a tiny home development, and 1 minute we were looking at partnering on the deal, and the next minute he's like, yeah, I'm not doing that. I got way too much work here on the West Coast. I no longer need to partner. I got more work than I can handle. And so I think some of the reconstruction over there in that coast pulled a lot of the workers that way, and it really kind of sucked the rest of the state dry. Probably drove prices up some too. They got to be. I mean, that was in Fort Myers probably a few months ago, and they still a lot of construction going on, a lot of demolition and a lot of stuff. So I think that's going to play a role for quite a while here.
Yeah, they got hit hard last year. I think it was September, end of September, and there's still you still see tarps on roofs, and it's wild.
Danny, can you hear me?
Hey, Ray, I can hear you. Sorry, I'm driving, so.
Oh, no worries. You're in the Orlando area, right?
Yeah, I'm more like south towards Kissimmee.
Okay, got it. So yeah, we're covering the right markets for you. All right, so I don't know if there's any other questions for you, Carl. I don't want to hold you up any longer. We're definitely going to take a look at these slides in more detail. I'm definitely going to post them out since this is being recorded, so we'll get this out. Unfortunately, I got a note while we were going here that apparently there was some issue with the connectivity of the linkage, and I don't know why. I think some people had to actually re-register to get on the call. So we did have some folks that could not get on, but thankfully we'll get this recorded. Carl, great information as always, and congratulations on that promotion, man. What's next?
Thanks. Yeah, who knows, but I appreciate that. Thanks, Ray.
Yeah, no, that's good. And obviously your expertise shows completely. So I really appreciate your time. I'm going to just hold for a second in case there's any other questions. If not, next time we've got a show is going to be in September. Let me get the date here for the group. It is on September, what is that? 21st. September 21st will be on next. So you do right before I get on stage there on the 23rd. We'll get that out to everyone, and hopefully we'll fix whatever the issue is with Zoom. But thanks everybody. Thanks, Carl. I really appreciate it.